Hi, it's Gail with TradersHelpDesk.com. In this presentation, I'm going to go through trading the Nadex spreads. Now, the Nadex spreads actually are composed of two price levels. One is a floor and one is a ceiling. They all have multiple expirations, and it could be either every 2 hours or it could have daily expirations. The floor is always the price on the left hand side. In this case it's $96. The ceiling is always the price on the right hand side, which in this case is 101. The price that you pay on entry is either the bid or the offer. If you are looking to go short, you sell the bid. If you're looking to go long, you buy the offer. Now in this example we have crude, and right now it's actually trading at 95.54. So if your bias is to the long side, you're going to buy the floor that is closest to price. Your risk is your offer minus the floor. The maximum profit is the ceiling minus the entry price. Now please take into consideration it will not get to the ceiling every time you enter a spread, but this is what defines the maximum profit potential. In other words, your risk is limited to the floor and your profit potential would be limited to the ceiling. If the bias is to the short side, then it's the opposite. The ceiling is what limits your price, and the floor is what limits your profit potential. So if you want to go short, you sell the ceiling, which is closest to price. Your risk is equal to the ceiling minus the bid price that you paid on entry. And your maximum profit is the entry price minus the floor. So in this case, you can see that the bias is to the long side. We're going to choose a spread that is closest to price, and we want a floor because we expect price to go up to the ceiling. So in this case, we're going to choose the $96 floor, and the ceiling is at 101.00. So our profit potential is the difference between our entry price, which is $96.15, and the ceiling, or $485. Our risk is limited to what our entry price is, which in this case is $96.15 minus the floor at 96, for a total risk of $15. Now, the greatest thing I think about Nadex, one of the greatest things, is the fact that all of the order entry tickets will tell you exactly what is going on when you enter a position. In this case, it tells you the floor is 96, your maximum loss is $15. Over here, your maximum profit is $485, and the ceiling is at 101. Now, an inverse would be if this had $485 over here and $15 over here. Immediately you could tell, ooh, this is not one I would want to enter, because there's an inverse relationship between your loss and your profit target. Okay, so let's look at what actually happened. We took a long trade off of the floor. We had $15 of risk, and we have $485 as the maximum profit target. At expiration, price closes at $97.30. Your profit is $97.30, which is your exit expiration price, minus your entry price at $96.15. The difference is 115 ticks multiplied by $1, which is what a tick is worth. So that gives you $115 profit. Now, if at expiration the price is at $95.50, you lose the $15 that you paid on entry. Notice that we do not subtract this from the entry price. We pay the risk on the spreads with Nadex up front. So if you're calculating your risk to reward, which means for every dollar of risk, what was the gain? It was $1 of risk to $7.67 of reward. If you're looking at your return on your investment, you actually increased your investment by 767%. Of course, if you had wanted to exit early, you also had that option on the spreads. What about if we had a bias to the short side? Then we're going to sell the ceiling, which is the price on the right hand side that is closest to price. Again, it would be the $96 area. Your risk is the ceiling minus the bid price on entry. The maximum profit is the entry price minus the floor. So in this case, our price is at $95.41. So if we subtract that from 96, we have $59 of risk and $441 of potential profit. Again, that's based on if it moves the entire width of the spread. Now, at expiration, price is at $94, so it did move in your favor. So you subtract $95.41, which is our entry price, minus 94, that's 141 ticks. At $1 per tick, that comes out to $141. Now on this one, the risk to reward was $1 of risk for $2.39 of reward. If you're looking at return on investment, it would be 239%. If price was at $96.01, then you lost what you paid up front in risk, which is $59. So as you can see, the spreads are an excellent trading vehicle for looking at risk to reward and also looking on return for investment. You just have to remember, do I need to buy or sell the ceiling and the floor? If you can remember those two things, and remember it's sort of like trading support and resistance. When it's at the floor, you want to buy. When it's at the ceiling, you want to sell. Then you can get an excellent risk to reward ratio or a return on your investment.